when I go on TV, which I do a half a dozen times a year, they always want me to say buy or sell, in or out, risk on, risk off. And I think this is too simplistic, too black.
Superficial, right?
I think so. The way I think of it is this. You mentioned thousands of people in the audience. Every investor, everybody in the audience should have a sense for what their normal risk posture should be. It depends on their age, their assets, their income, the relationship between their income and their needs, the number of dependents they have, what their aspirations are, how much they can tolerate risk, what is their intestinal fortitude. There are a lot of things that go into it. But I mean, from 0, which is no risk, to 100, which is complete risk, I think that everybody should have a sense for what's right for them. And that would help them define their normal stance in terms of aggressiveness and defensiveness. And, what is the right balance for you? I always say to people, people come to me for financial advice. I say, which is more important to you, keeping what you have or making more? And they say both. You can't do both with equal emphasis. Every attempt to make more introduces the possibility of not having any more what you have today. So you have to decide the balance between aggressiveness and defensiveness. And then if you're really bold, you can think about varying it over time as the circumstances require. As I mentioned before, Oaktree, we don't get in and out of the market. We don't defer bargain purchases because we think we know what the future is going to hold in terms of market action. But we do vary our aggressiveness. And we've done it a few times in a big way over the course of my career. And
what were those times?
Well, I mean, just to give you some examples, late 04, early 05, we were very worried about the market, so we went defensive. Mm-hmm. Sold a lot of assets, shrunk funds, liquidated funds, raised the bar for new investments. September 08, Lehman Brothers goes bankrupt. Everybody thought the world was going to end and the financial system was going to melt down. We turned extremely aggressive, and we invested, I think $650 million a week on average for the next 15 weeks. That's $10 billion in a quarter. And obviously that was a good decision. And then, 2012, from 2000 to 2012, if you invested in the S&P 500, you made no money. Zero return, as I recall. So I came out with a memo called Deja Vu All Over Again, I think it was called. And I said, back in 79, most of your viewers may not remember, but there was Business Week ran an article, The Death of Equities. And basically what it said is equities have done so badly that nobody will ever buy them, which makes absolutely no sense. If they've done badly, that means they must be cheap and people should buy them. Right. And that was the same condition in 2012. And I wrote Deja Vu All Over Again, and so forth. So the point is, we do vary our degree of aggressiveness and defensiveness. We vary our degree of fundraising, how much money we should have under management. Clearly, when the opportunities are better, we should have more money. When the opportunities are less good, we should have less. And I think that's an important thing that distinguishes Oaktree, is that we're willing to have less when it's appropriate. Today, I'm in a fairly normal posture, except increasing my aggressiveness. I think that the conditions for the bargain hunter, for the lender, for the asset buyer today are better than they have been since the global financial crisis, which ended in 2008. So, we've been tough times for the bargain hunter for the last 14 years. I think we're in a better situation today. So I would increase my level of aggressiveness. Well, Oaktree is primarily an investor in what we call credit.
Right.
Over the years, credit has had other names: bonds, fixed income, debt, whatever you want to call it. But that's our roots: high yield bonds, leveraged loans, and so forth. And the interest rates on all those things were the lowest in history over the last 14 years. And now they're much more generous. So you can accomplish much more in credit investing than in the recent past. And I think it's very, very viable. I think one of the things we're best known for is investing in distressed credit. Right. And also, I think that because the conditions are not going to be so just right, in the coming years. They were so good in the last 14 general conditions, which means bad for us. I think in the coming years, they will not be as generally good, which means better for us, better for the bargain hunter. So I think credit, distress, opportunism are the ways to go in the coming months and years. You asked sectors and industries. We don't really think that way. You know, in investing, there are two basic approaches. One is called top-down, where you say, well, what's the industry, what's the economy going to do? What are rates going to do? Which sectors of the economy will do best? Which industries will do best? Let's find some companies. That's one way to do it, top-down or strategic. The other way to do it is bottom-up. What's cheapest today? And that's more opportunistic, less strategic. And really, that's the way we operate. So, you know, when we go out into the marketplace, we just say, what's cheap today? It's kind of like, you know, if you're a shopper and you have a Saturday off, you just say, well, where are the sales? And we like to buy the things that are on markdown. Well, as I've said, you know, the last 14 years were really quite idyllic in the economy and in the market. We had the longest bull market in history, the longest economic recovery in history. We set a lot of records in many ways. Living was easy. Interest rates were low. Companies can get all the money they wanted. There were very few defaults or bankruptcies. You know, easy times. And I don't believe in forecasts, especially my own. Oaktree, as I mentioned, does not invest according to forecasts. But in general, we think that the living will be a little less easy in the months and years to come. So I think, you know, for us, the big question is it going to be easy times like the last 14 years or more back to normal? I'm not calling for a cataclysm, but I'm just calling for a more normal world where interest rates are higher. It costs more money to borrow. It's not so easy to borrow. Bad companies can't borrow. Bad companies can default. Bad companies can go bankrupt. It's a little more of a struggle. And this is not unusual. This is the norm. The last 14 years have been the unusual time. And so, you know, our long-term look is based on that kind of normalcy. The Fed has been highly stimulative for the last 14 years, kept rates low to keep the economy going. I think it's going to be less stimulative in the period ahead. I don't think it can do it forever. We've been investing in what are called non-performing loans, loans that the banks want to sell off for the last 7 years, since 2015. We do a little more every year. We have very good results. And the process, as you say, the rule of law, goes as we would hope. All of our investments in China so far have shown that pattern. And I believe that the leaders understand that if they want to have foreign investment, which I believe they do, they have to have the rule of law. People have to feel that outcomes are dependable. Now, the recent events have suggested maybe they're less so. You know, starting with a year or so ago, they made it life tough on the for-profit education sector. They made it life a little tough for some tech entrepreneurs and business leaders. More recently, of course, more saber rattling, seemingly a hard line out of the party Congress. I like to believe that the Chinese miracle. By the way, China's GDP is up 100 times in the last 42 years. That's a miracle. It's gone from 178 billion to 17.7 trillion. And I have to believe that they're not going to desert that. And they want to keep the economy growing. They want to keep the people happy, among other things. China's economic miracle has come from, number one, the involvement of the private enterprise system. And most people are not aware of the extent to which China has the private enterprise system. And number two, involvement in the world community and trade. And I believe that they're not going to give that up wholesale. So, you know, people describe China, and have been for the last year, as uninvestable. And I don't consider it uninvestable. I think we're going to continue to invest in China, but carefully, because we're not sure we know what the future holds. But, you know, we will continue to keep a high bar, but my whole career has been built on doing things that were uninvestable. As you said, high yield bonds in 1978, distressed debt in 1988, emerging market equities in 1998. These are all things that were under a cloud at the time we started, and they've been successful. That doesn't mean you should buy everything that everybody else considers uninvestable, but that is the place where you should start your search for bargains. Mm-hmm. If you want bargains, you shouldn't look on the pile of things that everybody knows about, loves, and is happy with. Those things are likely to have been bid up. Well, like everything else in investing, there's the on the one hand and on the other hand. It's never cut and dried. So on the one hand, number one, whereas alternative investments were innovative 40 years ago, they're nothing new today. And in fact, the world has gotten happy with them, as you indicate, and capital has piled in. So they're not as virginal as they used to be. Some of the opportunities have been picked over. Some of the markets have become crowded. Number two, in the low interest rate environment of the last 14 years that I've been talking about, people couldn't make the targeted returns they had in mind in just plain stocks and bonds. So they had to go out and do some innovative things to try to get some more return things. I don't think that requirement is as high anymore, given that interest rates are fuller. Alternative investments are supposed to have higher returns. So some people want higher returns. But on the other hand, what you have to realize, and everybody should incorporate this in their thinking, is that when you are investing in stocks and bonds, you're mostly putting yourself at the mercy of the market. Right. Most investors' efforts to improve on the results of the market don't work. Short-term trading, market timing, all these things, and that's why most mutual funds historically have not outperformed the S&P. Mm-hmm. So as I say, these are what we call in the trade beta markets. Most of your return comes from the market. Alternative investments are much more an alpha market, which is that your return comes from the skill of the manager. So the answer is, if you can find an alternative investment with a very skilled manager, that's probably a good idea. Mm-hmm. But if you make an alternative investment with an unskilled manager, that's probably a really bad idea, and you probably would have been better off with stocks and bonds. So there's no free lunch in the economic or investment world. I think alternatives are a very good idea, but they don't give you money just for doing it. You have to do it well. So if people are going to invest in these things, they have to do it well. I think that over time, as you say, there will be democratization. It's been hard for individuals to invest in alternatives until now. I imagine that Wall Street's going to innovate, and maybe regulation will change, and individuals will have a way to invest in alternatives. But it's not a free lunch. They still have to do it carefully.